Have you ever looked at a company's financial report and just, wished someone could break it down? Not just the numbers, but what's really behind them, the stories, the strategy.
Absolutely. They can be pretty dense, right? Our mission today is sort of to be that guide for you, to cut through the noise.
Exactly. We're taking a deep dive today into Triveni Engineering and Industries Limited, specifically their Q1 FY26 results, the ones from July 29th, 2025. Our goal is to unpack what these figures actually mean for you, what's driving things, and maybe what to watch out for.
And just so you know where we're getting this from, it's all straight from the horse's mouth, so to speak. Their official unaudited results, limited review reports, and the investor brief for that quarter ending June 30, 2025. That's our source material.
Okay, let's jump in. The big picture first, consolidated results for Q1 FY26. What's the initial, headline feeling when you look at revenue versus profit?
Well, it's a bit of a mixed bag, or maybe even a bit puzzling at first glance. You've got revenue from operations hitting nearly 1,600 crore rupees. Pretty solid.
But then you look at the bottom line. Profit before tax, PBT, just 2.9 crore. Profit after tax, PT, only 2.1 crore. That's really slim.
Wow. Okay. And EBITDA?
EBITDA came in at 76.5 crore, giving an EBITDA margin of just 4.8%. And the earnings per share, the EPS, is down at 0.20 rupees.
Okay, so solid top line, very thin bottom line. How does that stack up against the same time last year, Q1 FY25?
This is where it gets really stark. Compared to Q1 last year, PBT is down. Wait for it, 93.2%. It was almost 42 crore last year.
93%.
Yep. And Pat saw the exact same drop, 93.2%, down from 31 crore. EBITDA also took a hit, down 21.2% for 97 crore. And that margin we mentioned, 4.8%. It was 7.5% last year.
So across the board, profitability just fell off a cliff compared to last year. EPS must be way down too.
You got it, down 85.8%. It was 1.42 rupees last year. Now it's 0.20. It really puts into perspective why the chairman, Mr. Dhruv Sawhney, called the performance muted.
Yeah, muted feels generous, maybe. So here's the core question then. Revenue is up 22.9%, pretty good growth, but profit collapses. What happened? What's driving that huge gap?
That's the million-dollar question, isn't it? And you're right, the turnover increase was strong. It was boosted by a big 53% jump in alcohol dispatches, plus a 14% rise in consolidated sugar sales volumes. And sugar prices helped a bit, too.
Okay, so sales were moving, especially alcohol.
Definitely. The distillery growth was largely volume-driven, especially from some new grain-based capacity they brought online last year in Q1 FY25.
Right.
But, and this is the big but, the profitability drop came because margins got squeezed hard in three main areas: sugar, the distillery business, and their power transmission business, PTB.
All right, let's unpack those one by one. Start with sugar. You said volumes were up, prices were better, but segment profit dropped 80%, down to 7.6 crore from over 36 crore. How does that work?
Yeah, it seems weird, right? More sales, less profit. The main reason was a much higher cost of production for the sugar they actually sold this quarter. It wasn't about current factory costs so much as the sugar itself costing more.
How come?
It goes back to the previous sugar season, 2024-25. They had lower recovery rates then, meaning they got less sugar out of each ton of sugarcane crushed. That pushes up the cost per kilo of the final sugar. So when they sold that higher cost inventory this quarter, even with decent prices, the margin just evaporated.
Ah, okay. So it's a lag effect from a less efficient previous season hitting the books now. That's a key point for you, the listener, right? How well can they manage those recovery rates going forward?
Exactly. It highlights that vulnerability. Okay, now the distillery business, strong volume growth there too, as we said, but its profitability also took a dent. What's the story there?
Well, a couple of things hit them. First, their subsidiary, Sir Shadi Lal Enterprises SSLEL, its distillery part actually made a small loss, about 2 crore PBIT loss.
Okay, that contributes.
But the bigger factor was the mix of what they were selling. They sold a lot more grain-based ethanol, specifically ethanol made from FCI rice, that's Food Corporation of India rice.
Right.
That rice-based ethanol made up 27% of their total alcohol sales this quarter. And the issue is, it just doesn't have the same profit margin as ethanol made from sugarcane, like B-heavy molasses. So volume's up, yes, but the shift towards that lower margin grain ethanol dragged down the overall profit for the segment.
Got it. So volume isn't everything if your product mix shifts to less profitable stuff. And the third piece of the puzzle, the power transmission business, PTB, What hit their profits?
PTB had a couple of things going on. First, their turnover was actually down a bit this quarter. But on top of that, they had higher costs. They spent more to keep staffing levels up, anticipating more work down the line. And importantly, they had higher depreciation charges.
Depreciation. Why? Because they've been investing in expanding, right? Capital expenditure. As those new assets get completed and put into use, they start getting depreciated on the books. So you have the cost hitting before maybe the full revenue benefit from those new assets kicks in.
Okay, that makes sense. Higher costs, lower turnover, short term. Right, let's go a bit deeper into these segments now. Back to sugar. Domestically, sales volume up 13.6%, average price up 3.6%. We know profit was down due to costs. What about their inventory levels in the wider market picture?
Okay, inventory first. As of June 30th, they were holding about 44.5 lakh quintals of sugar, valued at roughly 37.4 rupees per kilo. Looking at the industry domestically for the upcoming season 2025-26, the forecast is for closing stocks around 7.4 million tons. That takes into account the opening stock and also about 4 million tons of sugar equivalent being diverted to make ethanol.
And internationally?
The picture's shifting. S&P Global was pointing to a global deficit for 2024-25, about 4.36 million tons. But for 2025-26, the outlook is more balanced, maybe even a small surplus of around 2.9 million tons. That's because crops are expected to be better in India, Thailand, Brazil.
Which would push prices down.
Exactly. International prices already started falling from April and hit multi-month lows in early July. So that's the backdrop. And crucially, the company reminds us that the sugar business is seasonal. Results can swing quite a bit quarter to quarter. You have to keep that in mind.
Good point. Seasonality is key. Okay, let's swing over to the alcohol, the distillery business. Operationally, you said production was up almost 19%. And sales volume rocketed up over 53%. Huge jump. But average price was slightly lower.
Yeah, slightly lower average realization, about 59.4 rupees per liter. And that ties right back to the feedstock mix we talked about.
Right, the shift away from sugarcane. Can you break down that mix again? Why is it so important for the listener?
Sure. So in Q1 FY26, ethanol from sugarcane sources, mostly B-heavy molasses, made up 46% of their sales. That's down from 58% in the same quarter last year.
And the difference went to grain.
Yep. Grain-based ethanol jumped from 42% last year to 54% this quarter. And like we said, the issue is that grain ethanol, especially the FCI rice kind, just typically has lower margins. It's less profitable than the sugarcane stuff.
Okay. And the wider industry context, how's the ethanol blending program going?
Well, for the current ethanol supply year, which runs November to October, the oil marketing companies, the OMCs, had procured about 637 crore liters by the end of June 2025. The blending rate achieved by then was around 18.9%. So moving towards the target, but still some way to go.
Now, this also raises a really interesting point for you, the listener, how regulatory changes can suddenly impact a business like this. Because the reports mention a pretty significant legal challenge involving industrial alcohol, right? What's going on there?
Yeah, this is a potentially big one. So back in October 2024, the Supreme Court, a big 9-judge bench, ruled that states do have the power to regulate industrial alcohol.
Okay.
And the consequence?
Following that ruling, the Uttar Pradesh excise authorities started demanding fees, they call them export pass fees, for moving denatured alcohol.
Yeah.
And they're trying to apply this retroactively from August 2018 all the way to June 2025. They're basing this on some old rules from 2004.
Right, and Triveni is fighting this. What's their argument?
They are, along with the State's Sugar Mills Association. Their main point is that those specific 2004 rules the authorities are citing, they were already struck down years ago by the Allahabad High Court, and the Supreme Court later dismissed the state's appeal against that High Court decision.
So Triveni's saying those rules are dead, basically. They weren't magically brought back to life by the recent Supreme Court judgment on state powers.
Exactly. They argue there's no valid existing law to support this fee demand right now. It's a strong legal argument based on precedent.
Okay, so what does it mean when the company calls this potential liability contingent in nature? How should you, the listener, think about that risk? And what's the potential financial hit if they lose?
Contingent basically means it's not a definite liability yet. It depends on a future event winning or losing the court case. If, hypothetically, they were to lose, the potential impact on the whole group is estimated at around 53.88 crore rupees for that period.
That's not insignificant.
No, it's a decent chunk of change. But the company, based on their legal advice, believes their position is strong.
So for you listening, it's something to be aware of, a potential risk factor tied to regulation, but one they are actively fighting with what seems like a solid legal basis.
Okay, a key regulatory risk to track. Let's pivot now to the engineering side. Power transmission business, PTB. Revenue down 8.2%, PBIT down quite sharply, almost 34%. What drove that dip?
Yeah, the Q1 performance was a bit soft. The company puts it down to typical lower customer urgency at the start of the financial year, and also some key deliveries getting pushed out to later quarters.
Okay, so maybe timing issues, but is there any good news there?
Actually, yes. Despite the softer quarter, the forward-looking indicators are pretty strong. Order booking was actually up over 15% to 84 crore. And even better, their closing order book, the total orders they have lined up, hit a record high of 423 crore rupees.
Wow, a record order book. That's a big number.
It is. It's up over 38% compared to the previous year. And a good chunk of that, 182 crore, is for long-duration orders, which gives visibility.
Any specific big wins in there that show where they're heading?
Definitely. They landed some important orders for compressors from ADNOC, the Abu Dhabi National Oil Company. That's a big international client. And they also got their first breakthrough order from Siemens Brazil. So it shows they're pushing hard on the international front and winning complex jobs.
So the current quarter was down, but the pipeline looks really healthy. Management must be feeling okay about the outlook then.
That seems to be the message. They expect demand to pick back up, supported by that strong order book and ongoing talks with customers. Plus, they're strategically moving into new product areas, like bigger compressor gearboxes, and really doubling down on international markets. That seems key to their growth plan here.
Right. Okay, last segment, the water business. Revenue up a bit, 6.3%, but PBIT, the profit, jumped massively, up over 80%. What happened there?
That big PBIT jump to 11 crore needs a bit of context. It actually included a gain of about 8 crore rupees that related to a previous year's activity on a specific project, the Mathura PPPAM project. So the underlying performance wasn't quite that strong, but still positive.
Ah, okay, a one-off boost in there. What about their order book?
The outstanding order book looks solid at 1,552 crore rupees as of June 30th. And what's good is that a large part of that, over 1,100 crore, is from long-term operations and maintenance contracts. That means steady recurring revenue.
But new orders in the quarter.
That was the weaker spot. New orders received in Q1 were actually down quite a bit, 58%, to just 5.3 crore. So a mixed picture there, strong backlog, but slow new wins in Q1.
And the general outlook for water treatment in India?
Very positive, really. There's a huge gap between the demand for clean water and wastewater treatment and what's currently available. So lots of opportunities, especially in areas like water recycling, reuse, and zero liquid discharge, which are becoming critical. The company sees this and is also looking at potential international projects.
Now, stepping back a bit, there's a major strategic overhaul happening, isn't there? This composite scheme of arrangement. Can you break that down for us? What are they actually doing and why?
Yeah, this is a really significant move. Okay, so basically they're doing two main things under one scheme. First, they're merging their subsidiary, Sir Shadi Lal Enterprises, SSLEL, fully into the main company, Triveni Engineering, TEIL.
Okay, consolidating that.
Right. And second, at the same time, they're spinning off their power transmission business, the PTB segment we just talked about, into its own separate listed company. That new company will be called Triveni Power Transmission Limited, or TPTL.
So merging one part in, spinning another part out, what's the goal?
The idea, approved by the board last December, is really twofold. Unlock value for shareholders by creating more focused businesses, and hopefully drive better operational efficiency within each separate entity, make them leaner, more specialized.
Makes sense, but it's not done yet.
No, not yet. They're still waiting for the green light from the regulators, the stock exchanges primarily, so it's in progress.
And speaking of SSLEL, the company they're merging in, its inclusion in the results this quarter makes year-on-year comparisons a bit tricky, doesn't it?
It does. That's a really important point for you to remember when you look at these numbers. SSLEL only officially became a subsidiary on June 20th, 2024. So Q1 FY26 is the first time its results are fully consolidated. That means comparing directly to Q1 FY25 isn't quite apples to apples because the scope of the consolidated entity has changed slightly.
Got it. Good reminder. Okay, quick check on financial health debt levels. Looks like they went up.
They did, yes. Gross debt increased both for the standalone company up to 1,385 crore from 1,150 crore year-on-year and on a consolidated basis, which includes SSL now, up to 1,688 crore from about 12,280 crore.
And the cost of that debt?
Also ticked up slightly. The average cost of funds for the standalone entity went from 7.1% last year to 7.3% this year. So, been more expensive to borrow.
Okay. Despite that, the overall tone from management from the chairman seems cautiously optimistic looking ahead. What signals are they sending?
Yeah, cautious optimism seems about right. The chairman pointed to the encouraging early monsoon trends in Uttar Pradesh. That's good news for the sugarcane crop, which obviously feeds into their sugar and partly their distillery businesses. They're expecting improved operating performance in FY26 because of that.
And anything on the cost front, especially for the distillery?
Yes, and this is key. He mentioned a meaningful correction, basically, a drop in input costs, specifically maize prices.
Ah, maize. That's important because of the margin issue with FCI rice, right?
Exactly.
Yeah.
Because maize prices have come down, producing ethanol from maize is now apparently more profitable again than using that lower margin FCI rice.
So that suggests they can shift their feedstock mix back towards more profitable options.
Precisely. It implies that the profitability squeeze we saw in the distillery segment this quarter, driven by that rice mix, should ease up. They can adapt. It shows their ability to react to input price changes, which is crucial.
Okay, so wrapping this all up, this deep dive really paints a picture of a company navigating a pretty complex quarter, solid revenue growth on the surface.
But profitability took a big hit, mainly from those cost pressures in sugar, the impact of the FCI rice mix and distillery, and some softness plus investment costs in PTB.
Yeah. But they're not just sitting still. They've got strategic moves underway, that big restructuring scheme, focusing on international markets for engineering, adapting the distillery feedstock.
And they're banking on strong order books in PTB and water, plus hoping for a better agricultural cycle with the good monsoon start. It's about looking beyond the tough quarter.
So the final thought for you, the listener, to chew on is this. You've got a company here with feet in two quite different worlds, the cyclical agricultural side, sugar, ethanol, and the project-driven engineering side, power transmission, water. Considering that mix, how might Triveni's big strategic restructuring, combined with their need to constantly adapt to things like crop yields and input costs, shape their ability to consistently create value and build resilience in what's clearly a very dynamic market?